Hello and welcome to the Higher Expectations podcast, where you'll hear from Ron, Josh, and Michael, a multi-generational family of real estate experts in Southern California. We're going to uncover valuable gems and insights on how you can grow your wealth, live life exceptionally, and toss in a little bit of motivation and inspiration along the way. I'm your host, Ron Hier, and my guest is my good friend, Steve Angebrandt from Edward Jones.
Hey.
How you doing, Steve?
Good to see you, Ron.
All right. Thank you. Thank you for coming. We really appreciate
Thanks
that.
for having me.
Yes. So Steve and I have known each other for quite a while, and I am so happy you agreed to come on our desk. He's on our guest on our show. and he's got a ton of information that I know you're going to love, enjoy, and be and very useful. We're going to say that, okay? So, Steve, how did you get into the financial planning field?
That's a great question, Ron. Actually, I moved here 40 years ago this year, the Antelope Valley. Wow. And when I first got here, I was in the janitorial supply business. Uh-huh. And I sold products for school districts and aerospace and expanded from there and basically grew in that business for 20 years. A friend of mine was in the financial services business, working for Edward Jones, and he would tinker with introducing it to me. I started really by getting into teaching finance, personal finance, to help people out. It was a volunteer thing. I did it with the City of Palmdale Parks and Rec Department with my local church. And we were helping people get out of debt, save for a rainy day, save for buying a home, and getting in the concept of saving for retirement. From there, I decided that I thought that I should do it full time. Mm-hmm. And so I finally took up my friend advice, and I applied for a position with Edward Jones 20 years ago now. 20 years ago this month, as a matter of fact. So,
that's good. Fantastic. Now, there's certain things we can't say. Can you say where your office is? Is that okay?
Oh, yeah.
Or is it okay for me to say where your office is?
Yeah.
Okay.
So, my office is in Lancaster, near Antelope Valley Hospital on Avenue J and Lowtree.
Very good, very good. So if someone, a young person, say my son, Michael, would looking for advice about how to grow wealth in the long run, what kind of advice would you give Michael and anybody, I'd say in their 20s and 30s? It's never too early, it's never too late to start saving. What would you recommend?
So I think the most important thing about anything with finance is having your house kind of in order. In other words, know where your money's going. Do a budget. I like Dave Ramsey's zero-based budgeting program, where you tell every dollar every month where it's going to go. Mm-hmm. And so in that, you plan for groceries, utilities, rent, mortgage, and for your future. Mm-hmm. And so you have an emergency fund, you have a long-term savings account, and then you have retirement savings. And so if you get started that way, where you're telling every dollar where to go, then it makes the progress work well long term.
Very good. Yeah. In that portfolio, is there like a percentage of total income that you recommend people set aside?
So that's a great question. There's a lot of different formulas out there. I believe that the best formula is start with what you have.
Yeah.
And when I started, when I was 25, I just got out of the United States Navy, and my other employer suggested we put into a 401k, and I'm thinking, I'm in debt up to my eyeballs. How am I going to put one penny into your 401k? But the person that was doing the training said, why don't you start with 2%? And so I started with 2%, and then every year I would up it. Whatever I thought I could afford, or sometimes I'd stretch it, and then eventually I got to a good level that I could understand. Once the momentum started in my personal savings life, I realized that maybe I could adjust some things and push myself harder. Mm-hmm. And so once the ball gets rolling, it's kind of like a snowball effect. Once the ball gets rolling, you get motivated by seeing your account grow.
Right.
And then you say, okay, can I do some more? On the retirement side, I would say you should try to get to a 15% per year level, saving for long-term retirement. And then I think short-term you should have for emergency fund 3 to 6 months of your expenses, meaning if I'm spending $3,000 a month, then I need to have $9,000 to $18,000 in an emergency fund.
And this would be like in addition to what you're setting aside for long term.
That would be correct. This is for short-term things like, oops, I got laid off, or I had an injury on the job. It's going to take a few weeks before some money comes in. Sure. I have the water heater go out of my house, those kind of things that you have a place to dip into and not necessarily use credit cards, but use your personal savings to get ahead on those issues when they come up. And then medium-term savings, things like buying a house, buying a car, I think you should do 5%. So when you add all that up, it's about 25% of your pie. It's a lot of money.
Yeah.
But if you get started the right way and live off of 75%, then you can get there. But you have to start small.
That makes a big point about the budgeting part. So if you know where your dollars are going, it's probably a little bit easier to set that money aside.
Exactly.
As opposed to just spending money.
Exactly.
It comes in and it goes out.
Yes.
It comes in and it goes out.
Yeah.
You know, managing your money is huge.
Right.
Yeah,
and what happens when you do that is you start looking at your purchases a little bit wiser. Let's say you go to Starbucks every day and you spend $6 to $8 at Starbucks or somewhere else and spend $10 a day. You may say, okay, I'm not going to treat myself to Starbucks every day. Maybe I'll, have a coffee maker at the office and get a cup there, and then I'll do Starbucks once or twice a week.
That would add up real fast.
Yeah.
Right?
Exactly.
$5, $10, $20 a week.
Yeah.
And then over time, that just compounds. That's very good. Very good. So what do you see as the biggest mistakes that people make when they're trying to get ahead and add to their retirement?
That's a great question, Ron. I think in my opinion, the biggest mistake is, I want to say it twofold. First, not starting.
Yeah.
Okay. And second, having a fear of starting. So, like me, I'll tell a quick other story. So when I left to come to this career, I took a huge cut in pay. I was doing very well in my previous career. We always had excess money, which is kind of nice. It doesn't always happen in everyone's life.
Yeah.
So I didn't do my 401k the first year at my new employer because I had a son getting ready to go to college. I had dropped my income in a third, but I knew that potentially I would do well. So I just, out of fear, said I got to just pay attention to what's going on right now with the dollars we have. But about 6 months later, I realized I'm not doing what I'm preaching. I better get back into it. So I got back into it right away, and I overcame that moment of fear and just stepped back into it. And I actually used the ladies' formula. I started with 2%, and then 6 months later, upped it, and then 6 months later, upped it again, and I just pushed through. So,
yes. Speaking of somebody's formula, there's a bunch of formulas out there for saving. Can you recommend any book or podcast or even a person, an article?
I would I'd recommend a couple of books. I do like Dave Ramsey. I like a book that he has called Total Money Makeover. It's a kind of a primer. He's a lot of people may have different opinions about his investment side of things, but on his saving, getting out of debt, he's an expert in that arena, and he's got all kinds of stories and ideas of how you can change things in your life so that you can get money put aside for those things that you want, including buying a home. So that would be one book I'd recommend. I think everybody, especially if you own a business, everybody should read, this is an older book, should read the book, The Millionaire Next Door.
I hope you're enjoying the podcast. If you're thinking about buying or selling real estate, or if you know of somebody thinking about buying or selling real estate, we would love to help them. Feel free to give us a call, text, or message us here. And now, back to the show.
because it changed. If you read the book, The Millionaire Next Door, you're going to change your concept of who millionaires are in this country and how the average millionaire becomes a millionaire.
Yeah.
And by the title of the book,
Yeah.
it's your next door neighbor.
Yeah.
And you never know it.
Yeah.
Because they live a normal life.
Yeah. I'm not sure. Is that Robert Kiyosaki or is that somebody?
No,
That's the Rich Dad Poor Dad.
Yeah.
Right. This is a different one. All right.
That's a guy by
probably
the
a good
name
one.
of Stanley.
Stanley.
Professor
Okay.
Stanley out of, it was Stanford University study that generated that
The
book.
Millionaire Next Door.
Millionaire
I've heard
Next
the
Door.
book. Maybe I've read it, but I don't.
Yeah. It's
don't remember that.
it's an older book. There's a revised version of it, but it came out about 30 years ago.
It's kind of like not penny pinching, but it's like driving modest cars, not the most expensive car, a reliable car, and doing things like you said, watching where your dollars go. That's probably part of that philosophy.
Yeah. So in his study, he found out that the average millionaire drove a Ford F-150 pickup truck or a Toyota Camry. So here we're thinking, Bentleys, Rolls Royces, and those kind of vehicles. And there are people who buy those, but the average millionaire drove a normal car.
Yeah, very good. Yeah. So getting back to my financial planning, when somebody's got some money in an account, it's best to be diversified, I believe. And how would you structure, or if you can answer that question, how would you structure somebody's portfolio for long-term? Probably a little bit different from like a 20-year-old, 30-year-old, 40-year-old, 50-year-old. If they're getting closer to retirement, it might be a little bit different structure. But how would you start with somebody that's got some money?
Yeah. So the first thing we try to do in our profession is, or in as a financial advisor, is assess each individual's risk. How much risk someone's willing to take, and on the opposite side, how much protection they desire. And so from that, then you kind of generate a personalized formula for each person. I would say this, though, investing in the stock market as a whole is historically one of the best places to put your money. It has long-term average around 10%, and sometimes over that amount. And yes, it does go up and down. I think that's important to understand. There is risk. But diversification, like you mentioned, is what's really important. You want to put your money in several different baskets. You want to own hundreds of companies if you can. You can do that through mutual funds and ETFs and index funds. And there's a variety of those out there.
Excuse me, I'm going to get back. I've heard of the term ETF. What exactly does that acronym stand for?
So that acronym stands for Exchange Traded Fund. So it's a mutual fund that's traded on the market at the time you put your money in. So it's traded like a stock. So when you buy an individual stock, Ron, you give me some money, we buy a company. The minute we put the order in, it's purchased. And so ETFs work the same way. As a group, it's buying a group of companies and it's purchased at the moment. Traditional mutual funds are purchased at the end of the day.
Oh, I see. I was going to ask you what the difference was. So mutual fund gets purchased at the end of the day. And
correct.
ETF gets purchased when they push the button, so to speak. Yeah.
And index funds work like mutual funds because index funds is a form of a mutual fund.
Right. And there's all kinds of different things out there. We had talked briefly about IRAs. So my wife and I have a couple of different IRAs. Can you explain what I say the difference? Probably the for me, I sort of common one. There's the simple IRA, the SEP IRA, and then the Roth IRA. Can you explain what the difference between those three are?
Yes. So you've got individual plans, and then you have business plans. And so let's go over the business side first. So if you're an owner of a company, you might use a simple IRA to have your employees participate in a business plan that they contribute to. The business itself will match some of that money. Traditionally, it's about 3%. That matches just a little bonus, basically, to the employee and the owner of the company. Then there's the SEP plan. That's more of an individualized retirement account for a business owner. it allows higher limits of what you can put in and take out of your business each year to contribute to the plan. So that helps the business owner have a higher, less taxable in their business, in their income taxes the year that they make those contributions, and gives them a higher ability to put a larger amount into those plans. Currently, I'll do this from memory. The business SEP plan will allow someone over 50, $31,000, and somebody under 50, I think it's $23,500
per year.
Yeah, per year. Yeah. So it gives you quite a bit of money if you're making money, and especially on a good year. If you're in business, sometimes you have very good years, and sometimes you have bad years. So it allows you some flexibility to not hide money, but bring money in and protect it from taxes in the year that you earn it.
Right. And then SEP is an acronym for
self-employed pension.
Self-employed pension.
Yep. Yeah. And then there's also in the business side 401ks, which is what most larger employers use. Same thing, has higher limits to contributions, usually a match like the simple plan. So then when it comes to individuals, that's where the individual IRA or the individual Roth come into play. The IRA is a tax-deductible product that I'm putting my money in, and I take a tax deduction in the year that I put that money into the plan. And the Roth is an after-tax contribution. The difference there is when I'm doing after-tax money into the Roth, when I go to withdraw my money in retirement, the Roth gives me my money with the earnings tax-free.
I like that.
Yeah. Where the IRA, since I took a deduction, I have deferred taxes to when I retire. Usually when we retire, we're making less money. So it works for some people if they take the deduction now, and then they'll pay taxes as they withdraw the money. So the longer you have to put money in, sometimes the Roth is the best benefit for you if you don't need the tax deduction now, because all of that's tax-free.
And maybe they could do a little bit of both?
They could, yes. Yeah, you can blend them.
You can blend them, yeah, because I'm thinking, I like that growing tax-free.
Yeah.
I don't know who wouldn't like that.
Yeah. And some 401ks do offer a Roth version in their 401k. Not all 401ks offer that, but some, and more 401ks are offering a Roth version inside their 401k.
Very good.
Yeah.
So I'm in real estate. And do you recommend having real estate as part of a portfolio? You don't have to get into it. Just a recommendation.
I have lots of clients who own individual real estate, rental properties, business properties.
Yeah.
We are all in for real estate. And then obviously we think you should own your home. Right. We believe that that's a great asset. And when you retire, you may sell that home, make a profit off of it, and move into a smaller home, or may move to another state, and so there's an ability to profit off of that period of time that you've been paying rent versus a mortgage.
Right.
The money's kind of, hate to say it, but I think you guys use this, is that money's kind of going down the drain, or it's going into the pocket of my investor.
That's just it. You're paying somebody else's mortgage.
Exactly.
If you're a renter.
Yeah. So we do like real estate. There's other ways to buy real estate in the investment world. Those products are called REITs, real estate investment trusts.
Yeah.
And they vary. They can own hospital corporations. They can own wellness centers for seniors. They can own strip malls. They can own individual buildings, business. Usually buildings that generate rent, and then they pay back a dividend to us, the investor, annually. And usually some of these REITs actually pay monthly, and so you receive an income, which is nice in retirement because it's like owning rental property, but I don't have to worry about the overhead, the management. Yeah. Did this guy clean his parking lot? I don't have to worry about that. There's a management company doing that, and I'm just collecting a check.
The one thing that, not that I was confused on, because I'm not 100% knowledgeable on the REITs, but they don't really get the depreciation off of that. Does anybody get the depreciation?
It's kind of priced into the kind of priced into the share price. Okay. So, but yeah, it's not. Unfortunately, you're right. There's no tax depreciation on owning the REIT itself. Yes.
And there's a couple of huge corporations out there that own a bunch of residential real estate. And one of them is called Blackstone. And I was just reading it this morning. Mm-hmm. And I don't know if they have a REIT for that, but it's like you invest in Blackstone and it's part of their return, or if they're going to spin off something like that and just make that residential income a REIT. Is there anybody like that out there?
Blackstone is similar to a REIT, and there are also REITs out there that invest in mortgages, for instance. Mm-hmm. In the residential real estate side, those type of companies are companies that you can invest in, and you would receive a monthly income mm-hmm. from the rents. Yeah, mm-hmm. Most REITs have to pay out their income, the rent, like at a rate of 90% of what they collect.
Very good. So what's the most common issue you come across with someone said, hey, I've got some money. What should I do with it? And then you probably analyze everybody's different. You can say, this is mm-hmm. the cookie cutter answer right mm-hmm. here. That wouldn't be good for anybody. What do you recommend?
So again, we go back to the risk and see risk and purpose. So somebody, it's funny you mentioned this because somebody called this morning with a check they're bringing in on some real estate they sold in Georgia. And so, if their goal with that money is to reinvest it in real estate again, mm-hmm. then I'm going to put it somewhere safe, somewhere that's going to earn some interest for a period of time until they need it. That could be a bank CD, that could be money market, high yielding interest accounts. But if it's something longer term, then we're going to look at stocks, bonds, mutual funds, mm-hmm. ETFs for building a portfolio that's going to grow for them.
So if they already paid taxes on it,
yes.
would they be able to put it in a Roth?
They could put part of that in a Roth mm-hmm. because there's limits on what you can contribute every year. So if they have not contributed for this year, they could put up to the contribution limits into a Roth. Mm-hmm. Yes.
Very good. So how often should one of your clients, any of your clients or anybody, review their assets with their financial planner? Is there like a quarterly, yearly, semi-annually?
Yeah,
every 10 years.
I think this is a great. I think this is a great point for conversation actually, because a lot of people will invest and then they watch it every day, and then they're like worried because it went up or it went down. So statistically, the market, if you're invested in the S&P 500, for instance, statistically, the S&P 500 is going to be down 46% of the time, okay? Yeah. And that means it's going to be up 54% of the time. So if you watch it every day, basically 4 days are going to be down and 5 to 6 days are going to be up. So it doesn't make sense to watch it daily. So the first point would be, check it once a month, check it after a deposit's made, pay attention to maybe what's going on the news. Don't panic because, again, those statistics rule out a long term. And then on the annual side, the market is up on average 72% of the years. So that means 7 out of 10 years the market's up, and we're going to have a few down years. And every year we have some down cycles. So the asset itself is kind of like you put the money in, you deposit monthly or whatever your sequence is, and then just let it go. Let it ride, let it build, depending on what you're investing in. But the other side, which is what I think you're trying to get to, is how often should you review with your financial advisor or somebody? So I would suggest with my clients a minimum. A lot of people don't like to talk about money, by the way, Ron. So there's a few things in life we don't want to talk about, and money is one of them. But I want my clients to come in a minimum once a year, mm-hmm. so that we can make adjustments. We can, life changes, right. Goals change, relationships change, so we can keep up on that stuff, make adjustments where it's appropriate. I also think that a little more often, 3 to 6 months is also a good, especially if you have larger sums of money, or if you're, with some of my clients and we're working toward retirement, once a year is not enough. If we're like getting close, like within 4 or 5 years,
Right.
a couple of times a year, maybe even a couple of months in a row, where we're talking about the actual retirement plan and what that's going to look like when they stop working, and how are we going to get cash flow moving to replace the money they were receiving from their employer.
Right. So earlier this year, there was a decline. I don't know what I'm going to call it, 10%. Maybe it was more, maybe it was less, and it happens not every year, but kind of. It's a part of the cycle. It does decline, and I'm not going to answer the question because you see it all the time. I feel that if the market goes down, leave it alone, because what I've seen is over the next 3, 4, 5, 6 months, it recuperates and then some. What is your?
So again, if it's it depends on how you're invested, partly. So if you've got a diversified portfolio of quality investments, quality companies, okay, then we reevaluate. But most of the time we're leaving it alone, because if it's XYZ company that pays a dividend and they earn so much money, and all of a sudden there's a temporary downturn of the whole market, it's like the rising tide and the lowering of the tide.
Yeah,
everything, all the boats float down and all the boats float up. So we want to wait through that period of time. Here's back to those statistics earlier. What we know is in a 1-year period, we're going to have 4 downturns. One of them's
go ahead.
Yeah, one of them's 10% or more.
Yeah.
So we had that in April.
Okay.
April 9th was the bottom, and then you'll have 3 about 5%. Those are corrections. They're not necessarily specific to anything. The one in earlier this year was, the news wants to blame something, so it was tariffs.
That's right.
So tariffs this week and something next week. So so waiting out that winds up working out. So if you're, here we are this last week, the markets have been at new highs that they saw in February and now have pushed above those new highs. Yeah. So the market always will rise to a new high at some point. And so as long as you're, again, in a quality portfolio, you should be able to ride through that.
Very good. Now, we didn't talk about this, and you don't have to answer it if it's not in your field. But on them, like cryptocurrency, do you do anything in there? Because I see so much of the stuff on television. There's Bitcoin, there's Ethereum, and then there's a stable coin. Stable coin sounds so secure.
Yeah,
but I don't know about that.
So we're not. So we are regulated by the SEC. Meaning that the products and services we provide are regulatory type of products. So at this current time, Bitcoin and that arena, cryptocurrencies, is not regulated. Now, this administration may be looking into ways to regulate it, and then it may be more secure by doing so. Our advice is your serious money, okay? Your serious money you need to put in things that we know will grow. We know that will be generally safe over a long period of time. But there's Vegas money.
Yes,
right?
there you go.
So Vegas money is the money I want to take and put on black on the roulette and have a 50% chance that I lose.
Right, yeah.
So if you got some Vegas money, there's obviously some opportunities in crypto. It's gone up quite a bit. It just hit a high about a week ago, and it came off the high here in the last couple of days. So that's on Bitcoin, but others are following it. So it's a speculative type of investment.
Yeah.
So a lot of risk to it, but
volatile.
Very volatile. Yes.
And like I said, it's had Vegas money. That's a good way to put it. I like that. All right. Do you have a favorite quote or reading or saying that you like to lean on?
My favorite is actually "Be still and know," from Psalms 46:10. and I think there's just moments of time that you have to just, even in the investing world, you have to just stop and take a look and don't panic, you know. And then the opposite end is when you're starting to get going, stop and look at what you're doing, and then seek the knowledge, and then start making the moves to get started. The sooner you can start, the better. I started when I was 25, but heck, if I could have started when I was 20, it would have been a nice extra 5 years. And I wasn't as serious when I was 25 either, but over the years, we've matured into that.
Right.
Yeah. So
there's an old saying that we talk about in my family. Michael and I talk about it, and it's like the best time to plant a shade tree was 20 years ago.
Exactly.
And the second best time is today.
Correct.
So that's very similar to the investing and saving for long-term wealth. Yeah.
And the shade tree is a great example because we planted a couple of trees in our yard last year when we did some re-landscaping, and it's interesting how quickly they're already starting to grow.
Yeah, you get to watch them grow.
Right.
How about that?
Yeah.
Very good. Very good. All right. So if anybody wanted to get a hold of you, how do they do that? And if you can't tell them, I'm going to tell them to call me. How would they?
That's easy.
Yes.
So we're in Lancaster, and we're on Avenue J in Lowtree. And our phone number is 661-940-5624.
Very good.
So you can call us. I have a great assistant. Her name is Jacqueline.
She's awesome.
She's been in the business with me 8 years, and prior to me, she worked for one of the major banks here in California. So.
Yeah, Jacqueline's awesome. She's very, very personable and very knowledgeable, just like you.
Yeah,
which is very good. So I want to thank you for coming onto the show. I really, really appreciate that, and to let everybody else know, for higher expectations and higher standards, choose the Hier Advantage, real estate, sales, and service. Take care, be safe out there, and have a great day.